This is James Kelly Sr. from Kelly Research Training and Technology, or KRTT.com on the internet. Thank you for joining me. It is our MMO product, or Major Markets Outlook. It's particularly an interesting time because we're just kicking off the second half of 2013, so we're going to try and not look back too much, but look ahead and give you some of those roadmaps into the major North American financial markets. We're going to be talking about bonds and interest rates. We're particularly interested in the stock market. A number of you have told me that, as well as gold, particularly interesting, and the US dollar. This issue is going to come out almost coincident because in the next couple of days we're going to look at, of course, the energy complex, lumber, copper, some of those other secondary markets in our SMO. I do apologize again for the production date of this. It is a little bit later than normal because of that very important Fed meeting where we saw corrections kick off in the stock market, the bond market. We saw gold capitulate. So it was a very, very big FOMC meeting. It almost upset the apple cart. In this issue, I also have an unusual bonus. Normally, we talk about a stock or an ETF or a specific investment. I'm going to try and attempt to teach you the single most important aspect of investing and trading, and that is trading or investing in your time frame in this issue. Now, we can't do everything in one of these issues, and there's a lot of things that we can't include. I do want to remind you that although we're going to concentrate on technical analysis and the trends and trading and investing in your time frame, that we don't discount statistical analysis, fundamentals, or the economic. Clearly, can the U.S. go it alone in a weak global economy? I think not. But we also need to ask all those important questions about those investments and trades that you have on. Can the U.S. be immune to an eventual sovereign debt crisis? We've talked about the fiscal cliff all year. Can it absorb the Ben Bernanke tapering schedule that was sort of hinted at in the last FOMC meeting, and particularly higher interest rates as we've seen with the recent bond market correction? What about high stock market valuations in the U.S.? What does statistics tell us about a long-run bull market, or a bull market that goes too high, too far, too fast? There's all of these questions and a whole lot more, so remember that you can't throw out anything. The key is that we always fall back on one thing, and that is what the chart says, because we always follow the trend. And that is why charting and technical analysis is invariably the most valuable tool, and that is why we teach it extensively here at KRTT with all of those other important topics thrown in. Now, as we get right into the first topic, which is the S&P 500 index, I just want to briefly go over what we said in the May MMO about 6 weeks ago. It was put out on May 16th, and again, following on with my cursor, you can see these black boxes indicate it's an old chart. And so this is an old chart we're looking at. And back there around the May 16th top, we had a very, very good call from KRTT. I said sell in May and go away. I said, as you can see in the red here, a CIT, a change in trend, would come very, very soon. I also put right at the top that the maximum high I could predict for the S&P was 1683. Well, the turn did come soon. It was May 22nd, and the highest high was 1687, so I missed by 4 points. That was one of the best calls we've made in months, so it was very, very good advice. But I want to go into this teaching topic and try and incorporate it. So as we look at our first up-to-date chart, we're going to take a look at the monthly chart. Now, monthly charts would never be used by traders, but they should be used by long-term investors. And over on the left here, I've got this topic that I'm throwing in as a bonus. Folks, I'm telling you that trading in your time frame is critical. It's what separates the pros from the amateurs, and it's why so few people really make money. The pros, when they sit on a trading desk or in the pit, on the floor, it doesn't make any difference. They always trade a specific time frame and a specific instrument. They don't trade everything and in all time frames. And this is really what makes the market so fascinating. So what you must do is decide if you're an investor, and even if you're an investor, are you a long-term investor? Do you want to trade every year, every 2 years? And you have to use appropriate charts. You can't adjust and say, well, I trade in all time frames. Sometimes I hold an investment for 2 weeks, and other times it's 2 years, and sometimes it might even be 4 years. years if it doesn't work out. If you're doing that, I can already tell you're probably not making money, and if you are, it's probably by the good fortune of being in a bull market. Remember that bear markets separate the pros from the amateurs, and you can give back a great deal of losses once this market turns. So what I've got is a lot of comments on this chart. Stop and read it, please. There is monthly charts for long-term investors, weekly charts, daily charts, which are used by both investors and traders, and hourly charts, which are used by day traders and traders of all time frames. The key is you cannot change once you put on a trade or put on a long-term investment. You must use appropriate charts. In this particular case, we're looking at what a very long-term investor may say. And if we come up here to the top right, we'll see that the latest month of June was indeed down, that we had this very high shooting star top in a very bearish candle in May, and there was a sell signal because we even came out of the linear regression channel, and I pointed that out in the week aheads as well as last month. So you normally wouldn't use a channel this wide and this long. It goes all the way back to the low of 2009, but the key is if you are a very long-term investor, what does this chart tell us? Well, we're still at the top of the channel. We're still way above the moving averages. And so you're not going to do anything as a long-term investor, and this is why there's still a lot of bullishness around. Other long-term investors, and even the ones that may be what I call amateur technicians, say the fact that we broke out here and we got above the 2000 high and the 2007 high means that this is a legitimate breakout. And in fact, after a breakout, we can either do an entire trading range again or some usually natural law proportion like 50% or 38.2%. So this is why the bulls are often saying, hey, really the S&P and the Dow can go a lot higher right now. This is a legitimate breakout. We may even be at the beginning of a new bull market. Well, we know that what I think about that. That's totally hogwash. I believe it's a top, and that's why I forecast down last month. But clearly, if you are a long-term investor, this is what you would get. Now, I also want to point out that we have seen a volatility pickup, and a volatility pickup does have some significance. So remember, there's many good questions here that we're not addressing here. QE taper, global economy, going it alone, etc. But the key here is what I'm trying to tell you is that if you're a long-term investor, normally you would be bullish right now, and you would be using a chart like a monthly and like a weekly chart for your analysis. When we turn to the next chart, the S&P 500 index weekly, again, I'm starting to look at investors. I don't see anything about traders in here. At the very top, again, long-term charts are going to be predominantly used by investors. I think traders need to be aware of them, that they want to look at those big trends. Remember, I've told you before that the big money is made on a weekly chart. These are indeed long-term trends, and so even a trader wants to be aware, is the major trend up or is the major trend down? But you'll notice that all of a sudden it's a little bit different here. We shot out the top here of the long-term, very, very long-term linear regression, and that one is outlined by these three straight lines with the dark blue. I also have a light green channel. Now, normally most investors, unless you're a very, very long-term investor, you would never use a regression channel all the way back to the low. It's simply too long. Even this regression channel drawn in green would be for a 2-year investor. So if you trade 2 or 3, anywhere say between 1 and 3 years, but around the 2-year mark, probably you want to go back about 2 years when you're drawing your linear regression channel. Well, we got outside the top of the linear regression channel that was 2 years. We even got outside of the very, very long-term chart that goes all the way back to the low in 2009. What do we have? Well, you'll notice that the recent prices here have broken one of the moving averages, but not the other. And I've got the moving averages drawn on, so this magenta here is a 21 period or about 105-day moving average if we looked at it in days. The key is that we haven't broken that longer-term moving average or medium-term moving average. I do want to point out that there has been a bit of a volatility pickup. Now, I can't teach you all topics in this one edition, but a volatility pickup is usually when the sentiment starts to diverge and go in opposite directions. In other words, the bulls and the bears start to fight. They can't agree. When that happens, you're going to see bigger bars. You'll notice here I've got small weekly bars. This is a very controlled ascent. So when we see small bars, well, everybody's sort of in agreement. But notice here at all of the tops, you'll see a volatility pickup. The bars are getting bigger. And the question I asked is, are they? Indeed, they are. In fact, one of the recent bars was 76 points. That was bigger than bars in the last 1.5 years. So we are seeing a volatility pickup, no doubt about it. What would it take for this investor to get bearish? Well, he would probably want to see a channel break, which coincides with a very, very nice support zone at the 1474 level, which would also be a channel break. So what does this chart tell me? Well, it really says that we're still in an uptrend. The weekly chart shows a volatility pickup, which is putting me on alert a little bit, but there's no technical proof. There's no broken moving averages. We're still in the top of the green channel and the blue channel. So until there's a break out of those channels or some type of major break, in this particular case a channel break, chances are investors are still predominantly bullish. Again, what I'm telling you is you must trade in your time frame to separate yourself and become more like a pro. If pros can do it, so can you. If you want to try and do everything in all time frames, you're really not using a plan. It's going to be very emotional. You're not using market intelligence. When I turn to a daily chart, in this particular case, I threw something a little bit different. I gave you a New York Stock Exchange Composite Index. Well, wait a second. All of a sudden, things have looked a lot different. Who uses a daily chart? This type of chart would be used by investors that tend to be a little bit more short-term. Maybe they trade every year. It would be by position traders who like to hold on average from, say, 3 months to 12 months. And short-term traders, well, the short-term traders, remember, have to look at an hourly chart, so they can't get too much. They can get some help out of the bigger trend, but they're still going to need to do some analysis on their hourly chart. Let's take a look at what we see. Well, first of all, the position traders channel, what I've done is I've gone all the way back about 6 to 7 months, back to November's low, a very, very good pivot point. It was also at the bottom of the longer channel. So this blue channel could be used by certain types of people using this chart, such as an investor. But if you're a position trader, you'd probably want something like this red channel. Well, let's take a look. First of all, the current prices are in the bottom of even the long-term regression. They've also broken out of the position traders channel. And frankly, if we regress prices going back to May 22nd, after all, that's about 5-6 weeks, we are in a downtrend and clearly in a channel going down. We've seen this correction, and again, it was kicked off back in May, and of course we've talked about that seasonal cycle. The key is we have a very, very different view. So when we're saying long-term investors and investors are still bullish, remember that position traders and shorter-term investors are already turning bearish. And that's true. The shorter-term traders are going to notice the change in trend in a market first. Longer-term investors using a monthly chart are going to have to wait several months. Naturally, they're going to leave some money on the table, but absolutely they have the benefit of knowing that a more powerful trend is indeed in place. So the key here is what we're seeing is a very, very long-term investor would be bullish. Now, if you're a shorter term investor and you want to go back just to this October 4th low, you would maybe be using the blue channel, and I call that an investor's channel. Well, we've dropped into the bottom part of the channel. That puts us on alert. We're below the moving averages, certainly below the 9-period moving average, and look at all of a sudden we have gotten even below the 100-day moving average, and that's about where we sit today. Now, the 200-day moving average is well below it, so that would be my first level. So if this market breaks down from here, we are going to probably go a lot lower, and in fact, chances are to the bottom of this channel. So our shorter term investors and our position traders and traders using this are already in a bearish mood and should technically be selling and staying short in their positions. Last but not least, I've gone to a trader's chart. Right at the top, short-term hourly traders. If you are a trader and you like to trade often, say every 30 days, every 60 days, every 2 weeks, or even weekly, the key is you're going to want to use an hourly chart as well as a couple of other time frame charts. Today we closed at 1614, and this chart is therefore right up to date. And what do we see? Well, interesting. A longer-term trader would probably be noticing on this chart that the high of 1687 back in May, which was about 5 weeks ago, we still technically are in a very large trading range that really right now has a downward bias. We are testing right now the top of that channel, and a trader such as a position trader or a trader who wants to trade positions every 30 days would be very, very aware that this channel slopes down and therefore is still bearish. Now, a short-term trader that trades, say, every week, he's in a bullish channel, but he's on alert because look what happened in recent days. The key is we're also testing Fibonacci levels. You'll notice that we are hovering right between the 38.2 and 50%. And again, this Fibonacci retracement going up is simply made off the 1559 low on June 24th, which was down 128 points. So what does this tell us right now? What does it tell us about the short-term outlook of the market? Because that's what these traders' charts and hourly charts do. Well, frankly, folks, it's negative news. It's still bearish. So in other words, the big trend still is probably down. And I'll tell you why. We've fallen out of this channel. We closed really technically on moving averages today or below moving averages. And here again, I'm using those moving averages because they're such a valuable tool. We would have to get outside of this blue channel sloping down and continue this chart going up. So right now, we're at a key make or break level. But the bad news, and the really bad news, is when we use these technical charts, we do have help from indicators. And notice that we've got negative divergence. We've had higher highs and we've got lower lows in our MACD indicator. We also, if you take a look at the black stochastic in here, it's actually trending down right now and looking like it's going to roll over. So I would say if we do start back down, well, there's quite a lot of downside, folks, all the way easily back possibly to the 1550 and even lower, because look at how far down this channel goes, this longer term trading channel. So again, the key lesson is to be a pro, you always trade in your time frame, you don't deviate. It's not chaos when you're doing your trading. You have to put a trade on, you have a time frame, and you use appropriate charts to tell you when it's time to fold your trade or it's time to hold your trade. And really, trading in a particular time frame matched to your personal needs is very, very important. And I usually do this topic, by the way, in KRTT private consulting that's done hourly. Very, very valuable. So I hope this helps. There's a lot of other aspects I could teach, but that certainly will give you a hint that when we look at the S&P today, well, you've got to tell me what your time frame is. If you're a long-term investor, as we saw, you're bullish. If you're a short-term trader, you're on sell alert and still generally bearish, as are position traders right now following this current correction down. Where do I think the market's going to go? Well, for me, I think it's going to go lower, and I think everybody knows that the seasonal cycle to me is very, very important, and normally in summers we see a correction, and I think that's exactly what's going to take place this summer. Now, I want to talk about U.S. Treasury bonds, and just before I do, I want to again go back to our May update. So this chart was again a month ago, and I put everybody on alert. Advice remains the same. Sell all long-term and medium-term bonds. I said we had basically hit a CIT, very, very dangerous, that we're going sideways. I said if we break this blue line, which we already had, it was dangerous. I talked about the weak indicators, and there wasn't much doubt that I had been saying sell bonds for quite some time, that I saw a very, very little upside with the zero interest rates. Bonds essentially went to the moon through all that Ben Bernanke quantitative easing and these long-term interest rates near zero. Was that good advice? Again, it turned out to be excellent advice because bonds really got into a major correction here lately. And the bottom line, if I just click back to that chart, you'll notice that prices here in the bond market were up at 145 and 7/16. When I go back to this chart, we're down basically 10 full points in the bond market. That's called a huge correction. In fact, the big treasury bond managers such as Bill Gross at PIMCO, they had their biggest monthly loss recently in years, so they're quite upset. And this, of course, breaks the Ben Bernanke promise. Now remember that bonds are supposed to really stay high because Ben Bernanke said he's going to money print. And so the key is, remember that bonds right now are in a correction. Now the bad news is the CCI is still weak. We've got a new low on RSI, and my advice remains exactly the same. Sell all long-term and medium-term bonds. When we look at interest rates, this is from last month. We were essentially at a yield on the TYX Treasury bonds of 3.08, and my advice was interest rates are going higher. Remember, interest rates go higher as bond prices go lower. Did that happen? It sure did, and it happened in spades. So you can see that the yield on a 30-year bond has gone up by a full 0.5%. We've seen a bigger move in the 10-year bonds and the 20-year bonds, obviously. So again, the U.S. Fed is beginning to break its promise of low interest rates. And I think this is really going to put a lot of pressure on the Fed. They may have to do something soon, and frankly, their action is going to have to be print more money and try and stabilize this market and knock those bond yields back down. Otherwise, we're going to have a real revolt, and I think sharply higher interest rates right now will really set off a bigger correction in stocks and create a lot of chaos. So anyway, do you believe the Fed or do you believe the chart? As we all know, I go with the chart. The trend on the chart never lies. I want to briefly talk about what we said in the past about gold, and we saw that gold has been in a correction, and it's quite amazing. We know that gold traditionally goes up with financial crisis. It likes inflation. The devaluation of the US dollar technically creates higher gold prices because it's priced in US dollars, and certainly there was one massive bet placed on all the money printing and the quantitative easing and, of course, the sovereign debt crisis. So this really meant a devaluation of the US dollar. So we saw a massive run-up in gold prices. Now, it's interesting that the money printing and the sovereign debt haven't been handled. And what this tells you is that you can only push on one theme so long. And this is why the bulls in gold lost a lot of money, because gold didn't continue that uptrend. It peaked. Now, KRTT, by the way, made a phenomenal call because we said it would peak literally within a couple weeks around that time. But this is taken from April. At that time, our bottom line was we were mildly bearish. We still needed more time to enter. Going into May, just last month, it was the same thing. We are out. Gold is possibly nearing a tradable bottom, but really if you go up here to our major advice, we said that the trend is not yet established, risk is high, swing traders only, and sure enough, we broke to the downside. And I did say that we potentially had to go up from there, that this is going to become a very critical point. And I said that it's either going to go higher or lower, it's a make or break level, and sure enough, it broke to the downside. And interestingly enough, again, Ben Bernanke seemed to upset the apple cart. Again, he said, well, you know, folks, I might not money print. And of course, that sent the US dollar up and it sent gold down. So the gold bulls have really been losing. What do I say right now? Well, you know what? Here's really what I say right now. It's time to begin getting bullish. This is a correction, folks, and I've got 6 reasons of why you want to look at gold, and you want to look at it now because it is a good time. My bottom line is I'm still out, but gold is clearly very close to a tradable bottom. We expect to put a long-term and medium-term buy on gold very, very soon, and it will happen, I say, this summer of 2013 within the next 4 to 8 weeks. Certainly this summer I expect to be showing you. Look at this RSI. We've got some positive divergence. We're right outside the channel. Now, traders exploit volatility, and if you're a trader right now, they'd be all over gold because they're saying, hey, it's gone down too much, too fast on gold. Now, when we look at a daily chart, I do want to show you something that last Friday we had a bullish engulfing pattern. In other words, we set a new low and then it shot right up. So Friday was a key day. We had a bullish engulfing. That is also called, in technical analysis, a new low followed by a high higher than the previous close is called a key reversal. And when you add that to the fact that we're outside of both of these channels, this is very, very bullish for gold in the short term. Now, the key Fibonacci target that I have is 1165. 1 or 2 days up does not make a trend for investors, and maybe not even for traders. But the key is short term, we do have some very bullish signs coming into place. Again, this is a very beautiful C wave. It breaks out into 5 portions now, so I do expect to be putting out an all-out buy on gold very, very soon. I do want to talk about the US dollar, and last month, this is what I said in our MMO. It really was a little bit bullish at the time, and I thought, well, you know, this trend looks pretty good. The CCI was still staying fairly strong. The MACD really started actually to turn up, and we also had prices get above the moving average and try and move into the top part of the channel. So I was a little bit on the bullish side, and again, you can stop and read this or make your own determination. And right now I'm sort of changing that, and the reason I'm changing that is because of what Ben Bernanke has said. What he's hinted at, of course, which upset the apple cart, is that QE tapering might someday come to an end. And as I said in the week ahead, it really didn't change money policy. It was just a hint that money policy might change and that they could technically begin to taper before the end of 2013. And I don't know if you can see the last couple bars, but we were right down at the bottom of the channel prior to that, looking pretty tenacious, and the dollar shot back up. Well, unfortunately, the CCI is still weakening here, and we did actually technically get an MACD sell signal. So despite the good news in the last couple of weeks, I'm actually putting you on fairly cautious mode here. I would be out of this. I really see that the dollar is going to struggle here. I think it's going to be volatile, and I don't think it's going to be a great trading environment. There's really not enough great ways to get in and make money in this. So all in all, I would be out of the dollar right now. In this update, I've tried to give you the most important advice I can give you on your road to make more money, how to profit, and that is trading in your time frame. No, you cannot change your mind. You can't jump from daily charts to hourly charts to monthly charts to weekly charts. You're going to confuse yourself. It's not having a plan. So remember that the pros in the pits trade a time frame. They do it day after day with a specific instrument. You must develop a mindset that is disciplined and trade in a time frame. And if you need more help, call me, do some personal consulting. I'll work with you. We'll develop a trading strategy. We'll develop a mechanical trading system to help you, but that is how you're going to bang out a higher profit. And really, as simple as exploiting volatility. I've taught you about Bollinger Bands in the past and regression channels. Remember that when you break out the top of Bollinger Bands, you can exploit volatility as you can in the downside. We just looked at one in gold recently where we're out the bottom of the regression channel. So I hope you've enjoyed this update. This has been James Kelly. Happy Canada Day again to our Canadian clients. We'll be putting out the SMO. And again, because this is being released on a Monday night, I will delay the week ahead product until tomorrow, July 2nd. And until I talk to you again the next time, I wish you all a very happy trading week.